Success stories from teams who have raised $50 million. Very exciting topic for me. I'm very passionate about capital raising, everything from investor psychology to marketing. So let's get things rolling here. And how about we start by introducing everybody. So when you guys have a chance, actually, why don't we start with you, and then you can tell us a little bit about how you got involved in capital raising and a little bit about your story. 2-minute answers approximately. Engage the audience whenever possible.
Okay, great to be here, everyone. I'm the president earlier today. If you were fortunate enough, you got to see our CEO, Joe Rankin, speak about our business, which is very exciting. I grew up in New York. I came back from college and started my life on Wall Street. It was Shearson Lehman back then. There was a lot of different iterations of that company at the time. Ultimately went to law school, became a practicing lawyer, was a serial entrepreneur for some time, and then I got to meet after his stint at Topgolf as their CEO. He and I went to raise money at a sports surfacing company that did a lot of things, including building MetLife Stadium. And then ultimately, he became the CEO of where I was U.S. employee number 2 after him. So we were sort of top-heavy, and that we had a CEO and a president and an EA, and that was in the entirety of the business. But Joe and I have raised money together on many different occasions for 3 different businesses. And while most of my activities are as a principal and not as a professional capital raiser, I think I could add some insights into what it's like to be in my position and do just that. So thanks so much for being here. For being here to see us.
Awesome.
Thank you. My name is principal broker and founder of. We're exhibiting here. I've been a lifelong entrepreneur. Started my first business at 16, so I've been raising money since I was 16. Also on season 2 of Dragon's Den up in Canada, which is, I guess, your Shark Tank, where it kind of started, and raised money for businesses in food and beverage, textile technology. Ended up being partners with the world's largest shoemaker out of Asia, and then into the mortgage business in Canada. And recently, in the last 4 years, we've been able to put out $300 million in private lending in Canada. So that is kind of the Coles Notes version.
Good afternoon, everybody. I'm from Boston, Massachusetts, and I'm glad to be here, so thank you for your time. I grew up in an entrepreneurial family. My mom and dad had a machine shop, and my parents grew it, and my brother and I worked there as young men, and we helped grow it. And we morphed it into a metal forming business where we made precise rocket motor cases for missiles. And then we started making shafts for jet engines, and eventually directional drilling housings for the guys that were, drilling for oil and gas. Anyhow, my folks sold that business and to a publicly traded company, and I intended to stay on for my whole career, but I wasn't accustomed to working in a publicly traded company because I'm entrepreneurial, so I found it frustrating and left, which kind of broke my heart. But I started another company making orthopedic implants out of a shape memory metal, nitinol. It's a material that's predominantly used for stents to keep your veins and arteries open should you have a clogged artery or vein. Anyhow, I took it and made bone plates, bone screws, bone staples, hammer toe devices, and a whole family of bone fracture devices. And I grew that business and eventually sold it successfully. And then after talking to my children at nighttime, when my daughters were younger, I gave them blank journals. We called them invention journals. And at nighttime, we'd invent new products. And one day, my younger daughter, who was 7, says, "Hey, Dad, let's invent a machine to make ice cream at home." And I said, "Well, that already exists." And she said, "Well, why don't we have one?" I said, "Because they're lousy. Sometimes you have to put the bucket in the freezer. You have to prepare the ingredients. You only make one flavor at a time. It can still take 40 minutes. And when you're done, you have to take all the pieces apart and clean the machine. It's a whole process, and it's a hassle." And she says, "Oh, that's too bad." And I said, "Well, what do you want to do about it?" And she says, "Let's make like a Keurig machine or an espresso machine for ice cream." And so thought about it, patented the concept. We now have 105 issued patents. We have a booth out here, and I invite you to come check out our ice cream. We have these cans that are shelf-stable. In the cans, we could have ice cream, boozy ice cream, non-dairy ice cream. We could have protein shakes, smoothies, cocktails, lattes. Everybody puts their pot in, freeze your product on demand. It tastes great, and I encourage you to try it, and you never have to clean the machine. So with this, I've been able to raise capital, and this business has raised $96 million to date without any investment bankers or any venture capital, just from people seeing and trying the product. And I'll talk more about that later. Thank you.
Very cool.
I'm not sure I like following on-demand ice cream, but I'll give it a shot. I'm CEO and founder of. We're a online investment platform allowing accredited investors to invest in real estate private equity funds. My journey was about 10 years on Wall Street doing merger and acquisitions. I then formed a broker-dealer that I ran for about 25 years. I had a hedge fund for 12 years, and when I started investing my own capital with my brother, we gravitated to real estate investments, started out with some crowdfunding platforms in individual deals. Basically, I was IRR shopping. That didn't work out very well. Saw a lot of ads for syndicated deals. That didn't work out very well. And so I built something that I wanted for myself, which was some way to search for, vet, and invest in real estate private equity funds differentiated from real estate deals. So over the last 4 years, we've done 16 different investments, a bit over 50 million. We've got 1,000 investors that have invested with us that we manage their capital, and we have a couple of new offerings. It's been a very rough time for the past 18 months or so with the level of interest rates, but we do have 2 new real estate investment funds that we're launching this week.
Awesome. So I've asked the speakers for permission to ask them pretty much anything that I want, and being that this is a panel about confidence, I actually interviewed a gentleman by the name of Matt Faircloth, author of Raising Private Capital, and he told me on my show that if you are not confident enough to bring your own mother into a real estate deal or whatever business you're in, then you don't believe in your deal. So I kind of wanted to touch on the confident part about this because that's what this panel is about. It's extremely important when you're presenting yourself to be sure that you know what you're doing in terms of the deal. So I'd love your thoughts. How about we start with, actually all the way back at, let's start with you.
Sure. So the reason I started my online investment platform at was to bring to accredited investors some tools that didn't really exist. So one is we only focus on real estate private equity funds. Every fund has an auditor and an administrator. For every fund, we have a third-party due diligence report, and the site overall makes it easy for a accredited investor click some buttons and to review the summary, strategy, team, documents, track record, etc. So these are all investments that myself, my brother and family and friends have all invested in. That was really the start. This goes back 6 years ago or so, and eventually more friends and family started co-investing with us to grow to that 1,000 investor level. So we have followed our own beliefs in investing in deals, and other investors have followed us into those same investments.
Okay.
Well, in terms of the confidence, I feel that it's important to have, in our case, our product is heavily engineered focused, and you need to have a technical prowess and understanding and even a command of the technology. And so we chose to bring engineers in-house so we could figure out problems and solve them ourselves, as opposed to hiring a consultant, an engineering firm, to solve our problems. I feel strongly if you can't figure out and solve your own problems, you can never be an expert at it, and you can never improve it. You always want to improve things, make things faster, cheaper, more reliable, etc. And so you really have to have the technical competence to be able to pull that off. In terms of raising capital and having confidence to do that, I've always felt that you have to be extremely transparent with your investors. Stuff goes sideways all the time. You have to figure out how to fix your problems and communicate that you have problems and these are the things you're doing. As soon as you're non-transparent or even cheat somebody, you're dead. And that's it. That's the last time you're going to raise capital. So I always tell young entrepreneurs the most important thing you can do is be trustworthy and create an open relationship with your investors so that when you go back and looking for more money, that they trust you and are willing to tell their friend or neighbor or brother-in-law and then see if they want to endorse you and bring them into the fold as well. So being technical, credible, and being trustworthy is what gives me confidence in raising money. I also invest in every round that we do, same with my family. So I would never ask friends or family or any investors to put money up if I didn't believe in it and wasn't investing at the valuation in which I was raising the capital.
Yeah, Matt, actually, real quick comment on that. I have a lot of friends that are teaching capital raising right now, and an interesting thing that they're talking about is that in order to be effective at raising capital, you don't need strategy and psychology. You just need to run a very good business that gets referrals, because if you asset manage correctly, if you run your business correctly, that's going to get a lot of raving fans. So shout out to Sanjay Seshadri for that. How about we go with you, Mark? Confidence in regards to capital raising.
I mean, getting confidence in capital raising comes through a lot of mistakes to start out. And I think when I started, I was kind of like, if you remember that cartoon where there's a bulldog walking around, there's a dog jumping over top of him going, hey, what do we want to do now, Butch? What do you want to do now? Like, that was kind of me when I was young. So I think when you get to a point where you settle down a little bit, you go from being crazy. Like, somebody wants you to be a genius, but they don't want you to be crazy because they want you to make the money. And one thing I realized quickly was I had to convince an investor to love me more than they loved their money. So that was my number one lesson I learned. And I think to get to that point, coming back to what you mentioned earlier about being trustworthy, there's a lot of times where you just got to say no to some investors because they start pushing you on returns and they start doing this and that. And I think you have to stand them up at the blue line and just say that enough's enough. I can't do that with confidence. And I'm going to have to take too much risk to deliver what you want. So, your money is just not what I need right now. And I'm not what you need. And I think you have to really be laser focused on your principles, number one. You have to be laser focused on what you can actually deliver. Especially you're in the real estate business, you know this more than anyone. I see things all the time where people are promoting 15, 20% returns. I have no idea how they do that without and sleep at night. So we're in a fairly boring business. We lend out money, we get paid, we give out monthly distributions, and if I never have to talk to my investor, everybody's happy. They just get their check on the 15th. So that is what I try and build into the business and what I try and promise and deliver to the investors.
Awesome. Dave, switch it up. What do successful capital allocators, sponsors, fund managers, business owners, and entrepreneurs do to raise capital that unsuccessful people do not?
Well, I think one of the most important things, at least in my experience, and that's speaking as a principal of a business as opposed to someone who's specifically in the capital raising space as a professional, is building the team and having the right team that could execute. Because I think Ben on a prior panel mentioned this, just team is critical. You could have the greatest product in the world and you could have the greatest service, but if you don't have the right infrastructure, and that starts with people, you're not going to be successful. And I do think that there's either a great idea with a beta test that works, and sometimes people go out there and do everything they can to just force the raise. you really need to build the foundation before you go out there, and you need to believe in it yourself, and it takes time to get to that point. So when you set out to go raise money, you really need to be prepared, and it's not a process that takes 2 months. It could take 6 months or more even to get some traction. So in my opinion, having a product that's differentiated but also having the team and being prepared are critical. And I think a lot of mistakes are made by those who don't really evaluate all those things carefully.
Matt, what do successful capital raisers and allocators do that unsuccessful people do not?
Well, I would encourage entrepreneurs to demonstrate that they have a passion for what they're doing. If you don't enjoy it, it shines through. You have to love what you're doing. Secondly, you have to move into an opportunity where it's a large market and maybe even a growing market. But then step back and say, this is the niche we're going to attack. It's not credible to say we're going to take 1% of everything. So if you could show a path to starting in something very provincial or small or a niche, and then saying, after we do this, we'll take on the next step and the next step. A lot of times I see young entrepreneurs say, oh, we're going to conquer the world, we're going to get 1% of it. It's not credible, and I think it's a mistake, and they lose investors.
I'm curious, how has your capital raising evolved? I mean, what did you do in the beginning that you no longer do versus what you're doing today?
I think at the beginning, I mean, everybody knows that your net worth is derived from your net work. I think at the beginning when I started to raise capital, I would send a lot of emails. I didn't follow up well with people, nor did I get on the phone enough. You've got to get on the phone and speak to people and develop relationships, and just sending emails doesn't work. The other thing that I've learned is to exploit my expertise. Warren Buffett's favorite book is a book that was written by Ted Williams called The Science of Hitting. And Ted Williams had broken down the strike zone into his strike zone. And Warren Buffett has commented repeatedly, and he's got a picture of Ted Williams talking about the circle of competence. This is not going to the internet and learning something. This is your own expertise, and I think it's really important, no matter how small, and just following up on your comment about exploiting your niche. You have to look at what you're good at, what you're great at, and exploiting that niche, no matter how small, and being the expert at whatever your service you're providing.
How about yourself? In terms of capital raising, how has it evolved? What did you used to do that you no longer do?
That's a great question. When I first started, I started in the angel investor network, which was very unsophisticated back in the day. Angel investors went on a gut. If you go through the angel investor networks now, they're all linked, and they look at financials and they really do their homework. So you need to be very prepared now compared to years ago. But I think the number one thing that has helped me is reputation, and I've raised most of my money now just through referrals. People refer. My last one was almost a $300 million referral. And so I made millions of dollars of fees, lending the money out, and which has brought us now to this stage in the successor fund that we're starting, Greenlight Capital. So, and I think those referrals just come back to being trustworthy, and I can't stress that more than enough that at the end of the day, you're the last one to eat, meaning you got to pay your investors first before you pay yourself or pay any bonuses to your people in your company. And once you do that and you start proving it and you have a track record, then literally the investments just start coming to your door without looking. So I think trustworthy is how you succeed, and trustworthy is how you fail if you're not trustworthy. So that's my biggest focus, is always doing what I say I'm going to do.
I know you work with the founders of Topgolf. Can you tell us over the last 12 months, what has been the most valuable thing that's helped you raise over $50 million?
Sure. I mean, I think it's being able to endure the market that we're in right now. I think it's been challenging, and I think, we've learned so much that we've been doing this now for more than 5 years, and I think reminding ourselves of what we went through to get here. We raised $60 million in the middle of a global pandemic, which we thought would never be possible. And right now we're out raising $50 million in an interest rate sensitive market, which is a lot more challenging than raising money in a global pandemic. So you can feel sorry for yourself and say, well, it's so hard. But I then think back, in April of 2021, the fact that we were easily oversubscribed, and I just have to remind myself, if we can get money raised during those kinds of scenarios, meaning people don't even want to go inside our stores, then certainly we can grapple with the interest rate sensitivity. So it's good to remind yourself of where you've come from and how successful you've been by having the right focus and having the right, what we talked about with being honest. So I think just reminding yourself of what you've been through and knowing that there's other challenges that are always going to be out there, but that if you focus, you'll get through those.
Being that you're in private equity real estate, I've noticed it's been a little challenging to raise over the last 24 months for this particular thing. What are you doing to raise even during economic calamities?
So real estate has had a tough time with rates being higher for longer. And it has already created a lot of distress with distributions to investors being curtailed or terminated for the time being. There are a lot of interesting distressed investments coming in real estate, from non-performing loans, pref equity investments, rescue capital, GP co-investment stakes. All of that is more on the structuring side of how you make that investment in real estate. And then there are a number of niche real estate investment strategies like cold storage, data centers, secondary investments that I think are very attractive and will be solid investments for the next year. Obviously, multifamily, there's a long-term trend that there's just not enough housing, although rents have cooled in the past year or so. The long-term trend is that rents will be going up. So I think multifamily will still be interesting.
What about you? Family offices and other successful capital raisers, what are they doing to continue to raise even during economic calamities?
Well, I'm raising money now, and you just have to show that the business model works and that all the parties involved have a chance to make a healthy profit. And so you have to show the value proposition when I sell my widget, or in our case, the pods or the machines, to my distributors, and they flip it to their customers, how everybody can make money along the way. If you can't do that clearly and concisely, you're never going to raise capital. And so I have to also be able to articulate how an investor is going to monetize this investment. What is the exit plan? How long do I think it'll take? Is an IPO possible? And so I think it goes back to what I was saying originally, is trying to be as transparent as possible. Things always change, and in a startup world, which that's the world I'm in, not real estate, in a startup world, you pivot. You have a plan, you do the best you can, and then an opportunity arises or a problem arises, and you pivot. And that's okay. You just talk to your investors about it and show that you're creating value. These are the things you're doing. Try to stay the course and make sure everybody can make money along the way, including the investors.
I'm curious if you can tell us, what are some deadly mistakes that capital raisers and business owners are making right now as they're attempting to raise capital? What are some of the mistakes that you see people doing out in the industry?
I'm not sure I can answer that definitively. I can tell you the laundry list of mistakes I've made,
Yeah.
and which are just long and distinguished. But you know, I think when you're raising capital, you know, to explain it to for Americans, we're in hard money lending in Canada, except we can lend on owner-occupied homes. So, and we're regulated, and it's very safe. Our default rates are 0.17% across Canada. Like, there's just literally zero defaults. So when you get into a market like we're in, that I'm going to say is very commodity-based, like money's a commodity, mortgages are commodity, you have to understand your answers, because I get it all the time, the questions of, well, it's a very crowded space. And the answer is yes, it is. But that doesn't mean people don't need or want money. There's no in between. So I say to most of the people I'm talking about, if you don't trust me and how I'm going to manage this business, then I'm not the investment for you. So again, I always come back to saying no before I ask for anything. I want to make sure whoever I'm getting into business with, I qualify them as an investor so I can manage their expectations. The biggest problems come from unmanageable expectations. And so even if, then the other question I get, well, what happens if the market crashes? Well, if the market crashes, we're all in trouble, like the banks and everybody. But then I have to become an air traffic controller. I just got to keep the planes in the air long enough so they don't run out of gas. That's what my job is as the manager. And then I can land them safely. So understand all the objections and hit the objections head on. And don't skirt around them and try and BS and sugarcoat it. Just hit it dead on. And I think you get a lot more respect from an investor that you're truthful with than trying to make, polish a turd, let's say.
Good. I'm curious because you're scaling your company extremely as fast as you possibly can. In terms of scaling, what are some of the things that successful capital raisers, or in your case, what are you doing? What are the mistakes that people are not? Let me put it to you this way. So if you're a scaling company, what mistakes can you make in the process of scaling that's going to inhibit your ability to capital raise?
Wow. There's a lot of mistakes you can make. I mean, obviously, I think for us, which sort of lends to the previous question, one of the biggest challenges is maintaining calm among all the stakeholders, the constituencies within the capital stack. That's really hard. And I think that for us right now, out there raising, new round of $50 million, we have to be very sensitive to the ordinary shareholders, which include our founders. And then you have the current preferred equity holders that are very focused on what their aggregate return is going to look like. So I think at the end of the day, when you're out raising new money, what you do not want to do is focus too much on pleasing everyone, but you have to do what's right for the business. Ultimately, the market's going to tell you what the valuation is if you talk to enough people out there that are either accredited investors or institutions or what have you. So I think the most important thing is to be honest with all of your stakeholders and say, if we want to raise this amount of money, this is the best valuation that's out there right now. We can try to raise less and then go out again, but that's going to complicate our ability to run the business right now. So I think the most important thing, in all honesty, is to, especially when you're scaling at the pace we are, is to know how much you need at this time, be comfortable with the valuation, and don't over-lever. That's probably the most important thing.
Any counterintuitive lesson learned or insight that you could share about raising capital, something that you wouldn't expect to apply that's been working for you?
Well, I do think, again, going back to preparedness is the most important thing. I think everyone always thinks that raising money is not going to take as long as it actually does.
Right.
I think everyone on this panel would agree, whether it's a startup or a real estate fund or whatever it is, even if you have the greatest thing that you're promoting, it doesn't mean that the market's going to think likewise, and you can fall in love with your deal or your company or both, but at the end of the day, the market's going to decide. So I just can't stress enough giving yourself extra time, especially in the market that we're in right now, to be successful. Because if you create an unrealistic time frame and you just add to the frustration and the stress, you'll end up not being your best self when you're out there. So it's really important to lay the foundation, be prepared for us to take longer, and just know that you have enough cash on hand to get through the hard stuff.
Any of you have counterintuitive strategies for capital raising?
So this isn't exactly counterintuitive. We've heard a lot about the importance of trust. My website is based on trust but verify. So corporate governance is critical, but we require an audit and an administrator to review all of the numbers. Beyond that, we have a third party do a background check. So even though you may trust the person you're working with, sometimes you need to go a bit further and verify the information. Another item might be that you might find something that's extremely attractive to you, but it's going to be a difficult deal, or you don't really like the person that you're working with enough. It might be counterintuitive that maybe you shouldn't do that offering. Maybe you shouldn't raise capital, because in the long run, it's going to be more important to like the people that you're working for, enjoy that journey of the capital raise, even if it's not the best deal. The best deal may be too difficult. You might not like the people. It may not result in the end product or the revenue that you expect. So work with people that you like, and you'll enjoy the experience.
Which one of you guys wants to answer, or I should say, would like to provide some parting words of wisdom before we ask one question from the audience? Parting words of wisdom for capital raising.
I'm just going to finish off that question you had. What's counterintuitive? Desperation. Don't be desperate. And coming back to what you're talking about, liking people you deal with, go back to old school, break bread with people, go for a 2-hour lunch, get to know them, bring them golfing. You never get to know people until you bring them to a golf course and see how they play. Right? Are they using the foot wedge? Are they counting all the strokes? A person's DNA comes out on these kind of things. And when you go to a restaurant, how are they treating the wait staff? Do they say thank you when things come? And if they don't do these simple things, then they're certainly not going to be the people you want to work with. I am telling you, desperation will kill you, and be very selective on whose money you take.
All right. One question from the audience. If not, we'll end with some parting words of wisdom. Going once? Who? Okay.
So you guys spoke about the returns that you guys aren't necessarily thinking are attractive for investors. Like if somebody's presenting a deal with 25, 30% IRR or something like that. So how are you guys structuring deals or your fund in order to not only serve the returns somebody would be looking for in this environment, but to present it to where it makes sense for both parties in order for you to successfully raise the money you need, and then have this a successful amount of relationships you guys want, or the investor avatar you guys want, in order to successfully not only raise the capital but have a successful venture through and through. What does that look like percentage-wise in this market environment, and who are those avatars you guys are specifically targeting?
Number one, if you came into my office and said 30%, I would just kindly walk you back out the door. And here's the reason why. Because your 30% is a lot less attractive than me losing 100% of my money. So, I always am weary of, and I'm going to put that into the desperation category. People come out desperate because and I see it in my business all the time. Like I target 9% plus bonus, but we show them modeling how they make the bonus, but I will never sell the bonus as what they're getting. That's just the icing on the cake. And that's what gets me the referrals, is never overpromising. So I would say don't be desperate, and if someone says they're getting 9%, you come and say, well, I can give you 10. If you don't know how you're going to deliver the 10%, don't promise it. And just stay away from the desperation, because I'm telling you, These are smart people you're trying to get money from, and they love their money. So how are you going to get them to love you more than they love their money? That is the magic.
Give the panel a ovation, a round of applause.
Join the Family Office Club by visiting familyoffices.com. We look forward to seeing you at our next live event.